Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime. On Tuesday's Stock Play of the Day, we talked about Netflix. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we looked at a short call spread in Netflix. I'm showing the short call spread right now inside the options playbook. It's also referred to as, and I'm going to point to it here, a bear call spread, which I think can kind of help a little bit on the call spread side to understand that we were bearish to neutral on the trade, and then also referred to sometimes as a vertical trade. So with that said, one second here. Oh, I had to get that out. So, okay, let's rock and roll with this concept. What we were looking at is the underlying stock is somewhere down in this range on the profit and loss graph, way down on the bottom half of the screen. And we sold a call, an expensive call with strike A, and then bought protection, bought strike B, a less expensive call option. The goal was to make as much of the premium as possible, the net credit received for selling the short spread overall. So as far as the markets are concerned, we had a lot that happened last week, not to mention the fact that we had a lot of earnings overall. And we're getting to the tail end of the earnings. A lot of the mega caps announced last week, a lot of the FANG stocks in general, Facebook, Apple, Amazon, Netflix, Google, all those stocks announced last week. And Netflix actually got beaten up a little bit because of that. But the one thing that I highlighted about the markets, and I'm going to show this in my watch list, was where interest rates were going. So I was talking about the TNX, which is the Chicago Board Option Exchange interest rate index. It tracks the interest rate of the 10-year bond. Now, all you do is move the decimal point over 1, and we breached the 2% level. So that's worth noting. Now, I do have this on my chart, and we see when we talked about it on Tuesday, the market was just above 19, and that was a scary level in general. But this week, what happened was we had the CPI came out and announced, and they actually, according to the New York Times, said that it climbed 7.5% in January, and that's the fastest rise since 1982. So that's what really drove the marketplace up above that 2% level. And I'm going to grab this chart and move down a little bit, and you'll see that we got to go all the way back. This is where we had the big gap down in interest rates, all the way back to July of 2019 to see that gap down in the interest rate level below the 2%. Now, the marketplace has things, especially with interest rates, right around nice round numbers. So it usually, as you see, it came after that big downturn, it came up and bumped up against the 2% level a couple of times, just couldn't quite hang out there. And now we finally see a breakout to the upside on the interest rates. So what has happened in the market? Well, because of that, the VIX has rose. The VIX is now trading around the 24% level. And I did talk a little bit on the show that I was surprised to see the VIX down around the 20 level. Not necessarily because of the actual volatility, just because I thought there was a little bit more angst in the marketplace. And what the VIX really tracks is the need to protect your portfolio. If you look at S&P 500 index options, you'll usually see that the open interest is much higher on the put side than on the call side overall. And that's just the general case. Why is that? A lot of institutions use those options to protect their portfolio, not necessarily to be bearish on the portfolio, but to try to hedge or protect their securities that they own long in their account. So when the markets are anxious, people run to that marketplace to buy put options, and that usually will drive up implied volatilities. The movement of the option contract as expiration approaches or over the life of the option contract. The VIX index uses 30-day options. They never become 29-day. They round them off. They do a calculation to make sure it's always a 30-day option. So when markets are nervous, VIX usually goes up. When the markets are going down, the VIX usually goes up. And that's what we see here. So the angst of the 10-year being up over 2%. We see the SPX down. Well, you can almost call it flat. It's down a third of a percent right now. And the NASDAQ is down almost 1%. Interesting to see the Russell 2000 index, or in our instance here, the IWM, the ETF that tracks, up a little bit today. So that is in general a good sign. It's good to see the small caps doing fairly well. And that usually overall is a good sign for the marketplace. It's good to have the smaller companies leading the way overall. But with that said, the VIX coming up to around the 24 level does not surprise me, considering what we saw from the CPI number and where inflation is at this point in time. Okay, so that's a little bit more than I usually talk about as far as the general market. So let's get into Netflix. So we're going to go and look at what happened with Netflix. On Tuesday, we talked about the trade. And we always do it live here on the stock play of the day. So I have a 15-minute chart that I'm showing you. This was Tuesday. This was noon Eastern time. And it was really annoying because we were putting the trade in and the market was all over, very choppy while we were doing the call. And the net credit of the spread was jumping all over the place. So after the call, the market actually went up fairly strong to the 405 level. We were down around 403. I think when I took my snapshot of the paper trade for the week, we were around 403. Market ran all the way up 405. It didn't really do much relative for Netflix, hung around the 410 level. It was going against us, but not even close to our short strike on our spread. Market came down precipitously, all the way back down below, a little bit up, and here we are. Now we're below where we started on the stock play of the day. We're at 397.50. So overall, there won't be much change to our spread as far as pricing is concerned, but we may be up a little bit. It really depends on what happened with volatility, because we have a big drop down. And one of the things that this is a good thing for the strategy, and we're happy that that happened, but sometimes that will drive up implied volatilities from the same thing that I mentioned about the VIX. When markets are going down, implied volatility usually has increase overall. So we have a lot of time in this option contract. Let's get to the Ally Invest option chains and let's look at the strategy. Okay, let me scroll up to the top. Let's see where the stock is at. Okay, so right now we're down 909 at 397.18. We looked at the March 25th expiration, 42 days remaining. Talked a lot about why we chose that expiration. We went quite a bit out of the money. We sold the 465 strike and we bought, or the 460 strike and bought the 465 strike. So right now, if we went and closed out this, it is trading at, well, it says a 70-cent net credit to the account. That is about where it was at when we were trying to place the trade on Tuesday. The market was a lot wider overall. The market's just, like I said, there was a lot of chop during the call. So at a few points during the call, it was trading as high as 90 cents and as low as 30 cents. Right now, we're seeing it right at 70 cents. That was our paper trade. That was the number that we picked. Always when you're looking at options, a lot of times we focus on the midpoint and we want to be able to trade somewhere near that. And part of the reason why is that you have wider bid-ask spreads in the options marketplace than you do in the stock marketplace. So the midpoint was right around 70. So basically we're right where we were at. I think I would just stay the course. We still have the same goal, the same forecast overall. If we could make half of the premium, we're okay. Ideally, we'd look to close it out around 15 to 20 cents. If we ever got down to that low, we'd really consider closing it out. Now, the thing that would make me stay in it a little bit longer than planned, our plan that we put together last week was to be in about 20 days on a 45-day option contract. So the only thing that would make me stay in a little bit longer is if the market did actually go down. So when we do a short call spread, we are neutral to bearish on the marketplace. So right now we're basically flat since Tuesday. If we saw the market trending downward and 10, 15, 20 points, then I might stay the course and try to make more of that premium overall. So market stays flat, time decay should help us out. If we just stay right here for the next 20 days, we should make at least half of that premium based off of just normal time decay of the option contracts. So this week is quite easy with the markets where it's at. It didn't scare us out of the trade, and it didn't make us want to close it out, right? So the moral of the story is that we want to stay the course. If I scroll all the way down to the profit and loss graph, kind of shows us where we're at. This is as of today, though, but we filled it in theory, we could fill it fairly close to the midpoint, which is almost where we were on Tuesday. And we see here's where the underlying stock is at. Here's what our outlook is. We got a long ways before we get up to that 460 level overall, and that's where our risk kicks in. And then as expiration approaches, we will see, let's go and cut this down. Let's cut this all the way down to about 10 days. All of a sudden, this line will start morphing into the dotted line. And as we get to expiration, eventually we're going to be right at that dotted line overall. And that's how time decay is going to work on our spread. So if we just hang here, we'll do okay on the trade. If the market does go down, we can maybe make a little bit more of the premium, and that's the goal. And I guess before I say my goodbyes, just in general in the marketplace, we got a little bit of volatility, got a little bit of predictability. Not quite sure where the market's going next, and I think the market's trying to figure that out. And because of that, I'm a little bit more interested in selling premium than buying premium than normal times for stock play of the day. So we'll probably look at a few more of these type spreads, short call spreads, short put spreads, maybe even get a little fancy and do what's called an iron condor, where we combine both of them. But with that said, thank you so much for coming for the Stock Play of the Day Overtime. Please click subscribe, ring the bell. We'll see you this Tuesday for the next Stock Play of the Day.